C.1. Analyzing strategic alternatives. Marginal costs and revenues. Adding or dropping products and services. Los A. Define relevant costs, sunk costs, avoidable costs, explicit/implicit costs, opportunity costs, and relevant revenues. Relevant costs, incremental, marginal, or differential costs, are future costs that differ between decision alternatives. Only costs that change as a direct result of a decision should be considered in analysis. Marginal cost refers to the cost of producing one additional unit, while differential cost represents the total change in cost between alternatives. Relevant revenues are future revenues that will differ across options and must be included in decision-making. Sunk costs are past expenditures that cannot be recovered and should not influence current decisions. Because they remain unchanged regardless of future choices, they are irrelevant to marginal analysis. Avoidable costs, however, are future costs that can be eliminated if a particular alternative is chosen. Explicit costs involve direct monetary payments, such as wages or materials. Implicit costs represent opportunity costs, the value of foregone benefits from the next best alternative use of resources. Opportunity costs are critical in strategic decision-making because they capture economic trade-offs beyond accounting figures. Los B. Demonstrate proficiency in marginal analysis for make or buy and add/drop decisions. Marginal analysis compares incremental revenues with incremental costs to determine the financial impact of alternatives. In a make or buy decision, only relevant manufacturing costs, such as direct materials, direct labor, and avoidable overhead, should be compared with the supplier's purchase price. Fixed costs that remain unchanged are excluded unless they are avoidable. For add or drop decisions, managers evaluate whether a segment's contribution margin covers its avoidable fixed costs. A segment generating a positive contribution margin may still be retained even if it reports accounting losses, provided it contributes toward common fixed costs. Effective marginal analysis requires isolating future, differential cash flows. The decision rule is straightforward: accept alternatives where incremental revenue exceeds incremental cost, thereby increasing operating income. Los C. Calculate the effect of a strategic decision on projected operating income. To calculate the impact of a strategic decision on projected operating income, managers compare incremental revenues and incremental costs associated with each alternative. The change in operating income equals the difference between additional revenues generated and additional costs incurred. Only relevant, future cash flows should be included in the calculation. For example, in a make or buy decision, projected operating income increases if the cost savings from purchasing externally exceed the contribution margin lost from internal production. Similarly, adding a product line improves income if its incremental contribution margin exceeds additional fixed costs. Accurate calculations require separating avoidable from unavoidable costs, considering capacity utilization effects, and excluding sunk costs. Proper analysis ensures that projected income reflects true economic impact. Los D. Recommend a course of action using marginal analysis. Recommending a course of action involves identifying the alternative that maximizes incremental operating income. The decision should be based strictly on relevant revenues and costs, excluding sunk or unavoidable expenses. The financially superior alternative is the one producing the highest positive contribution to income. When alternatives produce similar financial outcomes, managers may consider risk exposure, flexibility, and strategic alignment. However, the primary recommendation should clearly demonstrate how incremental analysis supports the chosen option. Strong recommendation explicitly quantifies the projected income difference, explains assumptions, and identifies key drivers such as cost savings, additional revenue, or efficiency gains. The conclusion should reflect both financial logic and strategic consistency. Los E. Identify and explain qualitative non-financial factors in strategic decisions. Strategic decisions require consideration of qualitative non-financial factors that may not be captured in marginal analysis. Product quality, reliability, and brand reputation can significantly affect long-term competitiveness. For example, outsourcing may reduce costs but compromise quality or customer satisfaction. Supplier dependability, flexibility, and innovation capability are critical in make or buy decisions. Poor supplier performance may disrupt operations or damage relationships with customers. Similarly, learning opportunities from internal production may build future competencies. Employee morale, job security, and organizational culture are also important. Decisions that negatively impact workforce engagement may reduce productivity. Considering qualitative factors ensures long-term strategic alignment beyond short-term financial gains. Customer profitability analysis. LOS F. Define customer lifetime value, CLV, evaluate long-term customer profitability, and make appropriate recommendations. Customer lifetime value, CLV, represents the present value of the net profit expected from a customer over the entire duration of the relationship. It incorporates projected revenues, contribution margins, retention rates, servicing costs, and the time value of money. CLV shifts focus from short-term transaction profitability to long-term relationship value, emphasizing sustainable revenue streams rather than one-time sales. Evaluating long-term customer profitability requires estimating customer retention probabilities, cross-selling potential, servicing costs, and acquisition expenses. Customers with high retention and repeat purchase behavior often generate significantly greater cumulative profits, even if initial margins are modest. Recommendations should prioritize acquiring and retaining high CLV customers, improving retention strategies, adjusting pricing or service levels for low-profit customers, and reallocating marketing resources towards segments that generate sustainable long-term value. LOS G. Demonstrate understanding of the implications of customer profitability for strategic planning. Customer profitability analysis highlights that not all customers contribute equally to organizational success. Some customers generate high margins and repeat business, while others require significant support and yield minimal profit. Strategic planning must recognize these differences to allocate resources efficiently and maximize long-term value creation. Firms may adopt differentiated strategies based on profitability tiers, such as premium services for high-value customers and standardized or automated services for lower-margin segments. Pricing strategies, loyalty programs, and marketing investments should align with customer lifetime value insights. Incorporating customer profitability into strategic planning improves segmentation decisions, product development priorities, and relationship management policies. By focusing on high-value customers, organizations strengthen competitive advantage, enhance operational efficiency, and increase sustainable profitability.